Another question that investors want to know is, how can I lose principal? How can my investment with you lose value? What does that look like? Well, to understand that, it's important to know that LIONSCOVE was built to preserve capital. Our number one goal is capital preservation, followed quickly by delivering consistent returns. But that capital preservation and setting ourselves up to be able to handle market fluctuations is critical. We look back at historical events of 2008, of 2001. We use the insight and the data from those, such as the Case-Shiller and the housing price index, to set what our strategies look like, what our underwriting looks like, to make sure that we can handle normal market fluctuations, to make sure we can handle effectively some black swan events and be prepared. Those other black swan events, that's the only situation we could potentially lose principal for you. If there's an unexpected event that has a negative impact on returns, that is not planned for. But even further than that, there would have to be a coming together of multiple factors that are all occurring at the same time to lose principal. Number one, housing prices would have to be in decline to the tune of 20% year over year. The second part of that is the courts would have to essentially have a moratorium, or there'd have to be a backlog on foreclosures due to government action, or again, backlog in the court systems. And number three, our borrowers would have to stop making their payments. So there's a big factors that would all have to be happening at the same time for us to be able to lose principal. So what do we do to protect against this? Several key strategies we employ. First is we take a conservative look to underwriting, specifically our loan to value. We do not exceed a 75%. That's what our target is on our portfolio, to have a 75% loan to value. That means at time of origination, we've got 25% equity in the properties. The good news is, as of recording this video in November of 2022, portfolio average was under 65%. So we're even more conservative than what our guiding principles are, knowing that there's market fluctuations in play today. The second thing we do and we look at is the term length. All of our loans are 12 months or less. We don't want extended exposure to the housing market where we're dropping 20+% year over year. We want to look at it in a short burst and be able to know exactly what that looks like. So we went back to 2008. That was the largest drop that we saw in the last 50+ years in the housing market, where the housing market nationally dropped about 21%. We use that as our baseline. That informs our LTV targets, our loan to value, right? And we've got 25% equity, and the biggest drop was 21%, right? So we still have a little bit of a buffer. And that was a year over year, which means 12 months. Our loans are 12 months or less, again, so we can pattern match that to make sure we don't have pricing risk to where the housing price is. On top of that, we typically only invest in non-judicial foreclosure states. That means that the foreclosure process does not have to go through the court system. To put it in perspective, in judicial foreclosure states, the process could be 2 years or more. In non-judicial states, it could be 2 months. That's a big difference when your borrower stops making payments at the time of which you can go and foreclose on the property and earn or get your principal balances back. In doing so, that coupled with the term length, coupled with our conservative loan to value, make it very difficult for us to lose principal. The last one, and one of the biggest ones, is that we're an unlevered fund. That means we don't have any debt against the fund today. That's important because when the market becomes volatile, there are things like margin calls, there's things like a mark to market on the portfolio for the debt line, a reassessment of assets, which change the conditions and put additional financial pressure on the fund, which could make the managers do things that were not aligned with the investors. For us, we don't have those risks because we don't carry debt. Any debt we do go and carry would be a line of credit for cash flow management purposes at a very small percentage that we're using very wisely. And we're not using a leverage to essentially grow the fund. That's not our strategy, and we're much more conservative than that. All of these things coming together, COVID is a great example of this. Earlier last year in 2021, when COVID was first coming out and there were moratoriums, a lot of our competition seized up. because of the things that we're articulating with the leverage and how they were underwriting. For us, we were in a conservative position expecting volatility, and we were able to flourish. A lot of the customers came to us from the competitors, and we were able to grow the business very rapidly, all while preserving capital and having some of the highest returns to our investors that we've had in a long time, to be honest. And so our underwriting and our conservative nature and making sure that we preserve capital first and foremost puts us in a position that makes it difficult for you to lose principal in your investment with LIONSCOVE.